Hey, it's 7:30 in the morning, 2 hours before the New York Open, approximately London lunch. You want to get together and do a little Forex trading strategy session? Awesome. I brought a briefcase full of technical and fundamental analysis. I thought I would share some. I'd like this to be an interactive, collaborative discussion or discourse, not necessarily just a webinar, me telling you everything. Why don't we collaborate a little bit as contemporaries? Sure, I might have been trading Forex a little longer than you, but it doesn't matter. Your point of view matters as well, as long as you take Forex serious. How many people here are serious about trading? I know there's some people that are just like checking it out and playing around with it and stuff, but how many people, this is their career, going to be their career? Yeah, hey, stand on your tippy toes when you say it, right? Because the mountain's not high enough. Awesome. Well, you know, before Forex, I was a venture capitalist, and before that, I was a successful entrepreneur that even helped other entrepreneurs raise millions of dollars. And so I've had this luxury, if you will, of being able to read, you know, I don't know, hundreds of business plans. And I've read hundreds of patents and invested in over 100 patents. And, you know, looking at the world from the point of view of an investor into other businesses, I've just never seen any opportunity better than being a Forex trader. In fact, I was in my skyscraper office right next door to the Fed in San Francisco, actually. Big, beautiful office, 3 windows, view of the San Francisco Bay and Treasure Island and the Bay Bridge. I mean, just loving life and living large, right? Large and in charge. And I ran into this thing called Forex, and I've been dumbfounded ever since. And so now I've been doing webinars at FX Street for over 10 years. And you know what? I still love Forex. I mean, I'm still addicted. I'm still fascinated. I'm enthralled. You know, it's the best, man. And if you get it right, it pays a little too much. So, yeah. So, yeah, it's funny, huh? Yeah, a little too much you can, Felipe. It's true. So, anyways, my name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, a lovely ECN that allows traders access to the Forex market through that ECN model, which means they're not betting against you and all that kind of stuff. They just simply pass your trade into the intermarket or into banking system through liquidity providers. Cool. But they also offer instruments such as energies, metals, indices, and binary options, which are pretty important, you know, when oil's finally going up, gold's finally going up. Cool, huh? And then yesterday we talked specifically, yesterday for Traders Way clients, we talked about using binary options to get yourself into an aggressive Aussie yen trade. How many people were there for this one, specifically this one? How to get into an aggressive Aussie yen pair that potentially could be going up but hadn't started going up yet. But your fundamental analysis said this thing was going to skyrocket, so the market's technically bearish, fundamentally bullish. How do you get in? We discussed buying the cash, which means getting into the Forex market. Why would you want to be long cash? Well, the best part of it is you have unlimited upside. Aussie yen could go up forever. If your stop's at break even, you could be in this for 5 years. It's not going to roll over like a futures contract, right? Plus, you also get interest payments every day, 7 days a week. You're mark to market. That means it goes into your account in real time. It's actually in your account and tradable. So the theory is you could take the profit from your first trade, which you're still in. So if you're in a stock trade, you'd have to cash out to collect the profit. No, in Forex, you get paid while you're still in the trade. So you could then take that profit and reinvest that by getting into a second trade, jam the stop, take that profit, get into a third trade, jam the stop, get into, so on and so forth. So you have unlimited upside and a beautiful interest rate payment. If you're leveraged 100 to 1 and you're borrowing Japanese yen for free and plowing it into the Aussie to collect 2%, and you've invested 1,000 of your dollars to get 100,000 Aussie dollars, right? Now, if you could just hold that trade for a whole year, 365 days, not including pips, just interest, you're guaranteed to make 200% return on investment on cash in. 200%. Oh, that's it? Oh, man, I can get something better somewhere else. So anyways, you want to be long cash, right? Because if you get 200% plus a few thousand pips, not bad, right? Oh, Joseph, you watched the video over again. That's cool. All right, cool. Now, what we did is we talked about a binary. This is a hedge fund trading strategy here. How can you get long this aggressively? Meaning at the time we talked about it way yesterday. Look at where we were yesterday. There was nothing bullish about this yet. So we talked about how do you get in, and what you do is you say, all right, I want in, I want the unlimited upside, I want the interest rate carry, but I want to reduce my risk. How does one do that? And we talked about using a binary option as an insurance policy to reduce your risk by 40%, but still get into the long-term trade, la-di-da-di-da. And this is what's happened since. 1, 2, you rock! Marina's up 219. Good job. Any questions? Now remember, I have a personal goal for these webinars here at FX Street. My personal goal is for you to make an extra 1,000 pips because of attending my webinars. I don't have anything to sell you. I don't have a DVD or anything, so don't worry about it. I just want you to succeed. So many of the things that I'm going to share with you is going to require you to do work. Oh, forget about it, Wayne. Forget it. I don't want to do work. Right? So I'm going to make suggestions, and if you carry them out, some have told me that the exercises were useful and helped turn their trading around. But you're going to have to do the work, and it is blood, sweat, and tears for years. But do you have anything better? Right, and you got something better going on? Well, I got me in some internet stock. Andy, why not Kiwi yen? Oh, sure. This was I picked one. Okay. Another theme that we've discussed lately, and this is probably not going to be a good one. Good chart. Maybe I'll just go to the Aussie yen again. One thing that we've been talking about lately is the power of the mean reversion. This is explaining a breakout here. Yes, let me clear some of this up. The power of the mean reversion. What is a mean reversion? Well, a mean reversion is when price comes back to the average, the moving average. Okay? And the moving average in this case, what I've been discussing is the daily 5 EMA. Okay? And one key to success is anticipating the moving target. So the example I love to give is you're a hunter and you want to shoot a deer. The deer is running. So a couple of questions need to pop into your mind in the 3 seconds of analysis, right? Is the deer running toward you, away from you, or to the side? That would matter. Okay. And the next thing that would matter is how fast is it moving toward you, away from you, or to side? And lastly, how far is the deer from you now? Because it'll take longer for the bullet to hit you, or hit the target. So therefore, your lead in front of the moving target is going to have to be greater. And then also the impact of gravity on the bullet will also take effect. The farther the deer is away, the more gravity is going to have effect, especially as the bullet slows down. So now air density, wind patterns, all of a sudden gets kind of complicated, right? But nonetheless, if the deer is running to the right, or sorry, to the left, I don't know, what was it, the deer's right? Okay, the deer's going this way. You have to shoot in front of it, right? Because if you aim for it, like, let's get my aim here. If you aim here, by the time the bullet gets there, it's missed. So you got to aim here. You understand? That to me are a bit of a guess. It comes with practice. All right. So what you want to do is find a currency that is trending, whatever your definition of trending is. I like to use the daily chart specifically for this analysis. Okay? And so I'll look at this in 1, 2, 3, 4, 5, many days in a row that we're moving in a direction. In particular, now we have a higher high, right? Cool. So do I buy up here? Well, if I'm a bull, I buy low. So it's my job to anticipate the next place I would like to buy. Now, you may notice a common theme here with these candles. Most of them, at some point, have touched the 5 EMA. Okay. Even though this didn't touch, it simply waited around for the next touch. Okay. Are we touching the candle now? Well, in 12 hours, the moving average will be somewhere up here, won't it? When we get a new candle? Right? And if the trend continues, where will the candle be? tomorrow. It'll be here. So what we want to look for is probably a little wick. And off we go. Hot to go, HTTTOGO. And what you should be planning now, and maybe not for the next 15 minutes, maybe it's going to take 12 hours. We don't really know. Okay? But we need to plan for this area now. Because at some point it's going to come back and touch the moving average. But the trick to the whole thing is that the moving average is moving and the moving average is lagging. You following me? So we have to adjust for the moving target. So I like to go through a sequence of questions. 1, is the market trending and in what direction, right? 2, if I'm bullish, I want to buy. Great. I have to acknowledge that. I can't sell this at all. 3, I need to identify 3 levels of support in which I might consider buying. And then 4, be ready. So a couple of things here. We know this is going to move up at some point. Why? We have a green candle, and when it closes, it's likely to still be green. I don't think this candle will be red by the end of the day. Do you? You think the probability will be pretty high? No. All right. It's probably going to be green, which means the moving average is going to have to move up because this is a 5 EMA, and it's looking at the last 5 candles, and the last 5 candles are green, 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 green. So where will we consider buying? So by and large, I like to do something like this. Or, this is all subjective, you do that. Okay. I also like to pay attention to price action. Past resistance very often becomes future support. Okay. And then I like to change time frames. Okay. You know what would be really nice is if we got a 618 Fibonacci retracement. 50% is fine. Okay. But see how we're at a psych level now? I don't want the psych level to hold because it wouldn't even give us a 382. So I'd like a little bit of a cooling off period. And I'd like it to come down 50 or 60 more pips to the midpoint psych level here, which is also a roll reversal. And then we buy it. Why would we buy it here? Don't tell me support. I want to know, I want specifics. Projecting the daily 5 EMA. Perfect answer, Felipe. Perfect. That's where we're assuming that tomorrow's 5 EMA is going to be. Yeah, Felipe has been listening. Your mother will be shocked. Oops. Doesn't sound like my Felipe. All right. Nice, huh? Is anyone going to purposely observe the daily 5 EMA and its movements over the next couple of weeks? This is where your work kicks in. You understand? This is what I mean when I want to contribute to at least 1,000 pips of your profit, but you're going to have to do the work, not me. Okay? Now, someone might also measure it this way, right? Just based on price action. You see how the 3A2 overlaps our area? It's pretty close to the 786. Okay. And this here is basically yesterday's trading range. Black Cat asks a really good question. Do I trade back into the mean reversion, meaning a counter trend trade? I can, but I generally don't. So I talk about it being, half the reward but twice the risk. There are times when I will counter trend trade, but generally not the one that we're looking at now. Okay. Yes, CAD's been a very nice trade. What an abrupt change, huh? Black Cat 9, life short, days long, nights, living on the edge, not afraid to die. Do you know that one, Black Cat? That you have a theme song? You used to play it in a band. Right. Yeah, right on. Black Cat 9, life short, days long, nights, living on the edge, not afraid to die. It's supposed to sound better than that. All right, so I don't have any pivots on this chart yet. There's pivots there. How funny. How do I get rid of that, huh? Guess I got to change the temp. All right. Let's get rid of this. Let's clean it up. I thought for sure I clicked delete indicator. There we go. All right, so let's zoom in here on this puppy. Okay, down, 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 down. Not much retracement on the bearish engulfing. Pretty amazing, very aggressive down. Okay, now imagine this candle. Okay, imagine this candle here. Okay. It was green for a little moment, then went back to where it opened, and it was super, super, super red. Full bar red, right? That's kind of like our candle now on the other chart. We have a giant green candle with like a tiny wick here, which means It's been up all day so far and is still up. At one point, this candle had been red all day, let's say up until the New York Open, but at some point retraced and closed here. So what does that look like on an hourly chart? It looks like this: down, 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 up, 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 down, 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 because you can see the next day was incredibly bearish again, right? What we're trying to do with the whole moving average thing is when price is here, we want to anticipate selling here. Okay? You sell the dip, or in this case, the rally. You sell the rally, not the trough, so to speak. Okay? So you have to say to yourself, okay, bearish, great, but I need the retracement. And it's going to come back to the daily 5 EMA. The problem is, when it has done that, retraced, let's say before the close, the 5 EMA hadn't moved yet, right? So you have to be prepared. How many times have you looked at your charts? You're looking back, yesterday or throughout the week, and you're like, man, why didn't I buy it at the 200 EMA? That's so obvious. You ever catch yourself doing that? Do you know why you didn't buy it at the 200 EMA or whatever it is? Because at the time when you were there, the 200 EMA was nowhere near that spot. That's why you didn't do it. It wasn't there. At this point in time, the 200 EMA was down here. Okay. So you need a leading indicator as well, and that's where price action comes in for me. Because if I wanted to buy this now, which is the opposite of the mean reversion, it's like, how do you turn this train around? You're looking at that. Okay. That would be price action technical reversal. But fundamentally, here's what I think of what's going on. Do you guys want to go fundies now? All right, give me $5. Come on, kick it up. Give me $5. High five, dude. High five. All right. All right. Too many traders were in the US dollar in anticipation of the Fed raising interest rates. And they figured it out that the Fed's not going to raise interest rates until December at best. Which means they're on the wrong side of the trade. Lots of people were front-running the Fed. Now remember, if you were watching CNBC and Bloomberg or reading the Wall Street Journal or the Financial Times, in August they told you that it was almost certain the Fed just had to raise interest rates in September, and if they didn't, it would be negligent. The world would freak out. It'd be the end of capitalism as we know it. They just have to raise interest rates. They just have to. Right? You remember that whole thing? Well, guess what? Dumb money decided to listen to the media and invest their dumb money after the dumb idea. And guess what? The Fed didn't raise interest rates, the dollar didn't get strong, and whoops. right? October either, because it's not a meeting with a press conference. So the best time for the Fed to change interest rates or to change their policy in any fashion, maybe they just simply raise the discount window. I mean, that'd be a great thing for the Fed, right? Because they've said, I've heard them say it about 5 or 6 times, raise the interest rate by the end of the year. Well, what interest rate? What if it's not the Fed funds rate? What if they just simply raise the discount window? They're like, well, we're not liars. We didn't do what you thought we were going to do, but we did something. We did change the interest rate, just not the interest rate for consumers. So they're not liars. And then they're like, yeah, and we'll wait another 6 months. Okay, so whatever. I'm just they have said it, but December is the most likely case, if at all. Now they could come out in December and say, you know what? There's been a lot of interesting bad things going on that we're just not, it's not anybody's fault here in the U.S., but they're risks. And so we change our mind. We're still data dependent. We've always told you we're data dependent. We're not going to raise blah, blah, blah. But anyways, long story short, way too many people were in on the hype. And they're in too late. They sold the Euro USD too low. And now it's time for the Euro USD to retrace, or in this case, USD CAD. Okay. So if the value of the dollar comes down because so many people are now exiting that trade, now oil can go up because the purchasing power of the dollar is diminishing and oil goes up. That might be one thing that's going on. Now, another interesting thing, and this is where trading and investing gets particularly interesting, is that maybe some of the correlations, at least over the next few months, will change. The stock market in the United States is way up, yet the dollar's still down. Well, a month ago, if the stock market went up, the dollar went up. Now the stock market went up and the dollar went down. USD yen, still the same price as it's been all month. Still $1.20, right? 120. So where's the money going? They're pulling the money out of their dollars. Remember, they were in the U.S. stock market, but now they're getting out of the U.S. stock market, perhaps, or the bond market, let's say. They're getting out of bond market, and they're putting it somewhere else, or at least taking it home. You notice that the Aussie yen is up and the CAD yen is up? Could be an interesting change. Interest rates in the United States are up. Just over the last few days. Hang on. Starting to rise again. Are people buying the 10-year T-note or selling the 10-year T-note over the last few days? Over the last few days, interest rates have gone from 2.0 to 210. So that means investors are selling the 10-year T-note. If prices fall, interest rates rise. It's an inverse relationship. You want to get jiggy with it? This can get complicated, so hopefully we don't screw it up. All right. This is a price. Come on, that's supposed to be a P. Price. Quantity. This is the demand for bonds. This is the supply of bonds. I don't know if I want to get into this. Then you have the opposite. And this would be the investor side of the equation. Should I get into this? Nah, I'm not going to get into this. This can go on forever. So, anyways, when the price of a bond goes up, all right, let's talk about it differently. I was going to go through the various supply and demand curves and how raising prices will lower interest rates between the two markets. So we're talking about money markets here, the price of bonds and the demand for bonds, blah, blah, blah. All right. How about this? You invest $1,000 today and buy a 10-year T-note. Okay? What's it worth? $1,000. How much does it pay you? $2. Well, not $2, but 2.1%. Okay? And in December, the Fed raises interest rates. And it goes to 2.35. Okay? So an investor, shortly after the change, is thinking about buying a bond. Will they invest $1,000 into the new bond? Or will they invest $1,000 into your old bond? Because let's say you want to sell it on the secondary market. You just want to get out of it. So on this side of the curve, so let's make it a chart now. Okay. Interest rates have risen from 210 to 2.35. What will happen to price? Because think about it. How would you convince a new investor to buy your bond even though it's paying less interest? It's like selling a used car. How do you convince someone to buy your car if they can get a better car for the same price? You'd have to lower your price. Okay? So what's very interesting is that one of the things that will affect price of bonds is not that the interest rates have changed, but that the interest rates are expected to change. Because the bond market is essentially an auction, a real-time auction. People will say, well, I don't want to buy a bond today. I'll just wait for the Fed to raise interest rates. But what if you want to get rid of your bond? You're like, no. Don't wait for the Fed. He's like, yeah, I know for sure the Fed's going to raise interest rates. It's probably going to be in December. I'll just wait. The interest rates are going to go up, and I'll just buy it then. You're like, no. Buy mine. Buy mine now. Same process, right? Just go ahead and buy it now. I'll discount it. I'll take a small loss on it, but it'll be your bond and everybody will be happy. Basically, you're getting December's bond today, right? Because your effective yield will be raised. But yes, you'll have a smaller interest rate, but you paid less money for it. So you got to take that lower price that you invested plus the interest that you earned, and your yield goes up. So you're basically getting the same 10-year T-note. You're getting the one that will be available from the Treasury in December. You can basically buy it today. So this is an interesting thing. So is everyone following me on this? The bond market. So now you could do something like Fed Watch, Fed Funds Futures. Okay. And this is what's happening. These are short-term bonds, if you will. And it's showing you the probability of a rate hike by the Fed. And what they're looking at is these auctions, if you want to call it an auction, all right, the bond market. Because people are just in the bond market buying and selling, buying and selling, buying and selling. Very, very liquid, right? But the prices change based on expected changes in the Fed funds rate, interest rates going up, for example. And it's not a survey of opinion per se. It's literally the price changing on supply and demand. So if you think interest rates are going to go up, right, you're going to demand prices go down to compensate you for that. You get it? Like I'm not going to buy that at full price when I just know for sure in December they're going to raise interest rates. I'm not going to buy your stupid bond. Well, what if I cut you a break? Yeah, well, cut me a break on the price, dude. Lower it. I mean, that's just how it works, right? So it's not like a survey. Hey, what do you think about it? No, this is money now. Trillions of dollars. Do you understand how powerful that is? If General Electric wants to keep its lights on overnight, it's got to pay attention to these markets. So what you can look at is the difference in price month over month. Because the Fed might not raise interest rates in October, right? But I think a lot of people believe they're going to raise interest rates in December. So for those that are interested in buying Fed funds futures, things are going to have to change price-wise to compensate them for what they think is inevitably going to be higher interest rates. So that's got to be priced in, right? They're like, look, that's it. Interest rates are going to go up in December. You're going to have to come down with the price if you want me to buy your DEES. This is how the market works, right? So check this out. Based on the price, that discount between the face value and the price. So look at futures price, 99.8675, 309, 99.86. Right? Look, it's so to buy $100 bond. Okay, it's only going to cost you $99.87. And the government, the United States of America, will buy it from you and pay you $100 back. That's how it works. There's no coupon payment. There's no nothing. And you can calculate the return, your yield, or your interest rate by simply how much is the price discounted. So what about the December? You loan the government $99.81, and they'll pay you back $100. You see how it works? For April, what month are we in now? All right, let's go this way. Okay? You can loan the U.S. government $100, right? Or actually, you loan them $99.51, and in 1 year they'll pay you $100. Huh. You see, the farther out you go, the bigger the discount. The bigger the discount, the greater your yield, right? Because you're collecting that difference. So you can look at how much price change. How much does it change, right? 1 month, let's say the difference between December and January. And what would change the price? What if 1 month changed more than the month before percentage-wise? Like there was a bigger significance in price difference. Then the assumption is interest rates will change. Okay? If nobody expects interest rates to go up in October, then there's not going to be much of a price discount because they're like, nah, interest rates are going to be the same. There's no difference between last month and this month. Right? You see what I mean? No need to discount. But what if the market is certain interest rates are going to go up in December? Well, you're going to have to discount that then, because I don't think they're going to raise in October, but they're definitely going to raise in December. So for me to get into that bond, you're going to have to lower your price. Okay? So you're looking at the month over month price differential. So you take let's say 99.77, subtract the current one, 99.86, and that gets you what? You can use that now and then put that over the price and you'll get probabilities. Okay? So anyways, based on all of this now, remember this is now the buying and selling of bonds, prices of bonds going up and down because of changes in interest rates. And as we saw, if interest rates go up, bond prices have to go down. So now we're looking at bond prices to predict the opposite. When does the bond market, now the bond market is way, way, way bigger than the stock market and supremely more important. The stock, who cares about the stock market? The only interesting thing about the stock market is IPOs, because that's a primary offering. If a company goes public or issues new stock, that money goes to the company. But for those day trading Apple stock, right? How much money goes to Apple? Let's say, what is it? 100 million Apple shares probably exchange hands every day. How much of that money goes to Apple? None. It's a complete waste of time. It's completely insignificant. Now, the bond market is very significant because you can see, like our crisis in 2008, if the bond market blows up, everybody's screwed and fast. Okay. Well, for example, Joseph, if, you use the bond markets to hedge, you use the bond markets to borrow money, you use all kinds of things. Okay, cash flows, all of this is important. Remember, so the bond market generally is corporations borrowing or the government borrowing. So in this case, we're looking at government borrowing. We're looking at changes in price based on expected rate increases by the Fed. And this is a professional market. It's deep, it's liquid, it's what, $1 trillion a day? I don't know. It's huge, which means it's a very smart market, generally speaking. And they think there's a 6% probability of a rate hike in October. But it jumps to 40% in December. And by the way, this gets updated every day because bond prices are fluctuating all the time. Demeter, it didn't blow up, it froze. So, for example, General Electric, which was, I think at the time, if not the largest company in the world, certainly close to it, top 5 companies in the world, billions and billions and billions of dollars in assets. Its hands it's knee deep in lots and lots of projects around the world worth hundreds of millions of dollars in future revenue. And yet they couldn't go to the bond market and borrow money for cash flow. So they couldn't even keep the lights on at the factory. So remember, you're General Electric, and you get a contract to build a nuclear power plant. Okay? What's your upfront cost as General Electric to build somebody a nuclear power plant? Let's say for Nigeria. Yeah. And how soon do you get paid? Right. So you got to hire the staff, you got to rent the equipment, you got to buy the natural resources and material, and you got to ship it all there, and then you got to build it and all that kind of stuff. And meanwhile, you got to pay the electricity bill while you build the nuclear power plant. So what do? You're good for the money. You go to the bond market. It's not a problem. People will lend you money. It's General Electric. You're good for it. It's not a problem. AAA rated credit rating. Extremely profitable. It's great, right? But if the bond market freezes up, you're dead in the water. And that's what happened to us. So that's where the Fed has to step in and create the liquidity, the lender of last resort. And so when Bear Stearns, when Lehman Brothers died, that's exactly what happened. And with the credit market frozen, lots of people got hurt very quickly. So anyways, now you're smart money guys, and now you can actually figure out when the Fed's going to raise interest rates. Is the Fed going to raise interest rates in October? No. So forget about it. So somebody was on the wrong side of that dollar trade. So now let's talk about it. If foreigners, right? If foreigners buy those bonds, then the dollar gets strong, right? What if they bought the bonds already? So they bought the dollar already, then they bought the bonds, and now they realize, now that the meeting minutes have come out or whatever, now they realize, by the way, that's the CAD news, now they realize the Fed's not going to raise interest rates and it's going to be later. What are they going to do with their bond? Sell it. Are they going? They're going to have to sell it for less they bought it for, right? And this is the interest rate going up. You see it, the rise in interest rates yesterday? That shows us bond prices falling because investors are selling it. And at the same time, the dollar weakened, so perhaps it was foreigners. And where are they putting it? Maybe a place like Canada. Maybe a place like Australia. Beautiful role reversal. See that? Okay, what should we cover for our last 15 minutes? Really? Bollinger Band? I don't. Yeah, generally it does, Kenny, but correlations can and do change. Oh, so you want to talk about Bollinger Bands? Fine. Fine, fine. Golly gee whiz. All right, here we go. Hang on. Okay. Yeah. MRC, you should follow all bond markets globally because rising interest rate differentials will impact global money flow and the valuation of foreign currencies. It's what we do. Okay. By the way, is anyone here at this webinar for the first time? Or close to it? Danny boy? Anybody else? Doji-san, Doji-san. And what do you think so far? Am I providing, I don't know, hardcore information, or am I missing the mark, or I just want to know how I'm doing, and if like maybe you already have all this information, right? Well, I appreciate that, guys. Yeah. Oh, you're following from the Trader's Way and stuff. Yeah. Well, that's good. I mean, I honestly really, really want to help. I want to make a difference. It's the prime directive, if you will. Okay? So if I get off track, you let me know, because I don't want to waste your time, all right? All right, so let's talk about Bollinger Bands for today. Let's move these out of the way. Bollinger Bands simply measure volatility. Okay? When the bands are at a 45-degree angle or greater, there's lots of movement in price. And then when they turn flat, what's happening is you're losing investors. So sometimes I change the facts a little bit. They are measuring volatility, but I sometimes like to look at it as volume. I know it's not right, but it's what I do, if that's okay. And when I see Bollinger Bands moving sideways, or they're very narrow, they're close to each other, usually both, right? Narrow and sideways, like it is here. I say to myself, nobody's trading. How much do I want to invest if I'm the only person in the market? I don't want to be in that market because I'm still not big enough to move it, right? Okay. And then you get scenarios like this, and there's lots of trading, but look at the bottom here stays vertical, and this rolls over. Do you think that's important? It is important. Now, I've seen both examples of this, or in this case, it breaks out. I tend to look at it similar as moving sideways. Okay? So that's the basics of it. I know you get guys like Boris uses two Bollinger Bands, one's two standard deviations, one's three standard deviations, and yeah, all right, that's not my style. I got enough going on. I don't need more information. But that's one of the major ways I use Bollinger Bands. It's almost like a volume indicator. Okay. One thing that John Bollinger does, and yes, it's the guy that invented the Bollinger Bands, John Bollinger. He talks about riding the band like this. So some people will tell you when it touches the upper band, sell it, and when it touches the lower band, buy it. You talk to John Bollinger, and he's like, "No, that's not right. That's not actually what it. No, right? So you got to be careful." Okay, and the reason I don't use the Bollinger Bands as much, I have a lot of experience, so I usually have enough information anyways. So just from experience, so sometimes I'll just rather have a cleaner chart and look at it. But you notice that in this case, we're riding the band. John Bollinger would be long and strong and confident, but I'm riding the five, and I'm also long and strong and confident. So I don't really need any of that. And then also you'll notice that I probably would be buying at the 21 anyways, right? Does anybody know that as a sort of a fact of my style of trading? Like that's my buy zone, right? I mean, that's just a given. I've been training that for 10 years at FX Street. So it's like, did I need the lower Bollinger Band to do that? And was the lower Bollinger Band there then? And all that kind of stuff. Well, whatever. But you see where the Bollinger Band is now? Is that helpful to you? No, not really, huh? I wouldn't make a big thing of it. Now, if the upper Bollinger Band was like this, the door's closed, right? So what'll probably happen is down, up, down, if the door was closed. So Pen on Fire says he was using the Bollinger Bands wrong before my seminars. Cool. Was there a well, what was the difference, if you don't mind saying, Pan? Oh, so you sold the touch, right? You sold the top and bought the bottom. Yeah, and that's how it's taught by a lot of gurus. But you have to remember, I'm self-taught, and I did pay attention to Bollinger Bands a lot at one point. Maybe that's why I still have them, but I use them a lot less. There was something that used to be called a NIME. It was called a nut in a million years trade, but that was a very specific one where the door would be closing and this would be skyrocketing up aggressively, and I'd say, well, what's the likelihood its price is going to go straight through that rising Bollinger Band? I'd say, well, not in a million years. So I'd buy it like this, but whatever. I'm a pretty conservative trader, so the things that I think are most important, if we want to end that way, would be support and resistance, right? Price action. So these together, I'm asking myself, is the market bullish or bearish? That could be a function of price action, let's say. So if we're doing this, we're bullish, right? So if we're bullish, I only buy at support. So now I have to ask, where is support? Okay, so I could say, well, this used to be resistance, so maybe this area will be support. So price comes back down, and then going back to price action, I want to see a reversal of this down move. So on a smaller time frame, I would see the big down move and then like that. And I want to be long here. Okay. I would start with that if I were me, starting all over again. And the trick is, like I said, to expect the retracement on the 4-hour and then buy the price action reversal at support on the 15 so that you're in concurrence with your 4-hour. That is kind of the next step. So the next step would be getting to know your fractal geometry. Okay. And then the next most important thing, and I say that because people find it more complicated. So you don't want to necessarily start there, but fundies. Okay, because to me, fundamental analysis is a leading indicator. And I'm on a regular basis talking 1, 2, 3 weeks in advance, sometimes 3, 4, 5 months in advance. Okay? So I'd get to know that. I do have a fundamentals analysis course. I'm not pitching it, but it's $1,000. Not cheap. If you put $500 at a live account at tradersway.com, they give you a 51% discount. So the $500 you put in your trading account at Traders Way is then subtract from the cost of the course. So basically, you get the fundamentals course and the live trading account for $1,000. And several people say it's worth $1 million. Well, I'm only basically charging 500. So if you want to see that, you let me know and I'll show it to you. So that looks about 5 people recommending it here. But I didn't want to make it a sales pitch, but it is something I have to offer. And it was actually FX Street audience that asked me to do it, so I built it. All right. So it's training.fxbootcamp.com. Okay. Any last I think we're over. So I guess we're done. Let's thank the admin and FX Street for being such wonderful hosts. Thank you, admin. I hope you have a wonderful weekend. Yeah. Are you done for the day, admin? Time to go home? Yes, I believe these sessions are recorded. Yeah. What is the best source for fundamental news? Do you mean like a news squawk service or deep economic data? You know what I tend to do, Rick, and it's probably not the answer that you're looking for, but I generally go directly to the central banks themselves. So, like this week, I've been to the RBA website, I've been to the Bank of Mexico website, I've been to several of the Fed websites. I've read the World Economic Outlook by the IMF, which was released this week. I've been to the World Bank website this week. So that's all this week. So I don't tend to rely on any other source but the original source, so to speak. When I first started trading Forex, I had something like 27 magazine and newspaper subscriptions. I actually had newspapers flown in from London and Tokyo. Tokyo. It was like I'd get one newspaper a week, and it was like $1,000 a year because I had to have it flown in by airplane. What an idiot. But it was fabulous to have boots on the ground, so to speak. Was it worth the investment? Well, 10 or 12 years later, I'm still sitting here. Well, this was a long time ago, Black Cat. This was before most newspapers were even on the internet. The way I always looked at it, and you're like, it's one trade. So, not a problem. All right. Anything else? Okay. Well, Good luck and take care of, take care of yourself. Remember, have a focused approach to your demo account. You cannot trade your way into success. What you have to do is practice very, very specific methodologies. For example, today we covered mean reversion of the daily 5 EMA. That's all I talked about for the first half an hour. And that's something that you should probably practice, and I mean practice, every day on maybe a dozen different pairs, setting up that one particular thing. Is it trending? Where's the 5 EMA going to be today? Where's tomorrow's 5 EMA going to be today? And how can I anticipate where it's going to be, and how well am I good at anticipating it, and which pairs am I best on anticipating it, and when I'm right, how right am I? But when I'm wrong, why am I wrong? And what influenced the change in direction? And, how can I recognize that better? You could literally spend the next 3 months practicing that one thing. But I'm telling you, if you just did that once, I wouldn't be shocked. Improved dramatically. And then we work on a second methodology for you to improve on. Look, so it's already had a huge impact on John. Right on, Johnny. Yeah, it's called, it is a good strategy, a good approach. Yeah. All right, thank you guys. So hopefully you'll open an account at tradersway.com. So we can work together every single day, and maybe I'll see you in the Fundies course. I'm going to try to create 2 videos today on to wrap up the study guide for the Series 34 test. Monday, I haven't decided yet. It is Canadian Thanksgiving on Monday, and I am Canadian, so if I feel like taking it off, I'll let you know. But I'm very often here anyways, so. Yeah. Yeah, and Japan's closed. Yeah, I probably won't do it. If Japan's closed too, then no, I probably won't do it. So anyone interested in passing the Series 34 test, the retail off-exchange Forex test? Yeah. Well, that's something I prepare you for. Oh, the test, actually taking the test, you would have to register, I think it's with FINRA. And if you're outside the United States, then you'd have to be proxied and all that kind of stuff. No, because it's just a test, right? So I don't believe you'll need a sponsor. More importantly, though, I think you should at least know the information in the test, right? CMT, I'm not a CMT, so I wouldn't know, but I did look at their reading list, and I bought every book on their reading list. And I don't know, it didn't seem that hard. Of course, the stuff that I wouldn't know would be like Elliott Wave There's probably some cloud stuff, so I'd have to like, have YJ teach me. All right, guys, peace on earth. May the pips be with you. May your profits be above average. And, thank you for your loyalty. I really appreciate it. It'd be a cold and lonely world without you.